So, in fact, you'll be surprised to hear that I think in 2006, on one of the expiry days in one of the months in 2006, probably July, August or something, we did like $1 billion notional trade in index and Nifty options in one day. In a normal industry, there are finite truths, right? And AI machine learning is finding them. In the markets, it is not like that. There are no finite truths. There might be infinite possibilities. And then there is no one way to look at the markets.
On today's episode at Success Documented, we're joined by Mr. Rishi Kohli. With over 2 decades of experience in the markets, he has served as the Managing Director of ProAlpha Capital, Managing Director and CEO of Quant Strategies and Avendus, and currently serves as the CEO at InCred Capital's Hedge Fund Strategies Group. And he's also the co-founder of LAQSA. Be ready to learn about hedge funds, quant strategies, and the future of systematic investing. How are you today?
I'm fine. Thanks, Sharon.
Good to have you on the show.
Same here. Good to be here.
So, starting off, tell us about your journey into, finance and then quantitative finance specifically. What was that like?
Yeah, sure. So it all goes back to, college days. And I went to IIT Kanpur for mechanical engineering. But like 6 to 9 months within that, I realized I was at the wrong place. So obviously, I had to sort of pivot and shift careers. So there were some courses and some stuff that I liked, but overall I knew I didn't want to be either a mechanical engineer, which is what I was doing, or obviously the other thing people do at that time is, go into coding and software and IT stuff, which I was good at, but I didn't think I wanted to pursue that as a career. And therefore, it was very clear that I needed to do an MBA to sort of figure out other options going forward. So the good thing was that I, in the first year, I realized that I needed to head in that direction. And so it became more about preparation for CAT, etc., to get into the IIMs. And then once I got to IIM Lucknow, which is where I went immediately after IIT, I immediately took a liking to finance out of the, finance, marketing, ops, HR. Those are the kind of things you do in the first trimester. And I immediately got a liking to finance, and within finance also very quickly into derivatives the moment, that started being taught. So that sort of naturally transitioned. And even within derivatives, weather derivatives were very new globally. So I tried to write some papers, do some research around that, apart from obviously equity derivatives and commodity derivatives, which were the other large asset classes. And even that, research, even though weather derivatives was different from equity commodity I liked, but even the weather stuff, I found it very interesting. So I think the finance and then the derivatives part just happened naturally.
That's very interesting. And so you started with ICICI, I believe.
ICICI Securities.
And what was your career like going on from that point?
Yeah. So, ICICI Securities was sort of one of the best, more technical finance jobs from campus in those days. Luckily, I got a chance to be there. So actually, they were taking me in ICICI Treasury earlier, but I was very insistent that I want to be in the investment banking arm. Because actually, initially, I thought I want to get into more investment banking kind of stuff. Obviously, the interest in derivatives was there, but I also thought investment banking would be very interesting, and I could mix a lot of other structures and other things in there later. And then and therefore they then put me in ICICI Securities. And then in the first year, just like global investment banks, ISEC used to rotate you across different areas of the bank. And while we were doing that, the Indian equity derivatives market had taken off, and ISEC was one of the largest institutional and one of the first institutional brokers to dabble in that space. So the guy who was heading it, he needed some help on research, started testing us flunkies out one by one to help him. And among all the people, I liked what I was doing when I got the chance with him. He liked what I was doing. And I think because of my interest and a little bit of background on the derivatives research that I had done from my B school days, that also helped. But that was obviously all theoretical. This was practical, and I liked that side as well. In fact, I liked the practical side even more. And therefore, it was a no-brainer to sort of go more deeper into that direction. Luckily for me, ISEC business boomed. The guy heading it, he was strapped for people. He liked me as he was testing us out, and he asked my boss whether I could, move out of that rotation program and get into the business straight away. And for me, it was good because it just saved 6-8 months of my career, right? Rather than rotating across the other areas. I was responsible for research, which was like daily, weekly kind of reports and some strategies. And then there was a guy who would execute it, like the dealer, we call it in India, but a trader basically. And but then suddenly the volumes increased so much that you had to do everything, right? So I had to back up the dealer also. So I would, in the expiry week where the volumes were the largest, I would also become like a dealer and help that guy out. And then when my boss who was doing the sales, heading it, was traveling, or when he was overloaded, then I would also back him up on the sales side. So it became a very steep learning curve very quickly, where you could dabble into all the related areas and therefore learn a lot also. The other thing that helped was he had actually traded global options markets. So he had managed a family office for some Middle Eastern family and been traded US options markets. So there were a lot of learning, a lot of thumb rules, typical trader thumb rules, which he knew and, he would discuss in the discussions with me. And that I would try and then relate that with the theory that I understood. So that became a very interesting and steep learning experience as well. Then very quickly I got interested in technical analysis, and but obviously being from a more maths and stats background, I was more like, okay, how can we make this more systematic? So I wasn't fully systematic in those days, but I started sort of learning the initial stages of how to become more systematic or more rule driven at least. And then because of my love for both technicals and derivatives, started combining both the things, which was not common. I mean, even today is not so common globally also, right? It's not that derivative guys get more into the maths and stats side, not necessarily technicals, and technical guys will not necessarily do derivatives. So that interest and combination I started getting automatically at in those early years. And then therefore started delving deeper into more quant and derivative research to try and figure out how best to marry the two things. So that also helped me because then I would read a lot of books, I would talk to a lot of people globally also, a lot of batchmates who were in global hedge funds. I also used to do random stuff of, just emailing Nassim Taleb, for example, just sending him a Bloomberg and asking him some questions. And the interesting thing is he would respond.
He would?
Yeah. So, and that's one example. There were others like in later years. So I'll come to that as I tell you the next journey. So from ISEC, then I moved to SSKI, which was the institutional arm of Sher Khan, which is a well-known local brand even now. Now I think it's part of a global firm, but people still know about Sher Khan. So, SSKI was a large institutional broker on the cash equity side, but was the last large broker to start doing derivatives. And they felt that obviously because they were the last guys, they needed to do something different. So it was not very common in those days for people in the financial industry to, bet on younger guys and give them a lot of responsibility and freedom. But SSKI, they met people like me, they liked me, and they asked me to come on board. And it was very entrepreneurial kind of, business plan that we had. Because the founder, promoter there and the CEO of the equities business were very clear they don't understand derivatives. So they said that you understand and you have some new interesting ideas, which is what we want. And therefore, within obviously a cost budget, you're free to run however you want. And in those days, in the derivatives market in India, it was basically cash futures arbitrage that used to happen. So whether it was local funds or global prop desks operating in India, they were all doing cash futures arbitrage because you could make like 15 to 18% risk free by just doing cash futures arbitrage, right? So which is very, very strong returns with no risk. So the whole world was doing that. And therefore the local derivatives broking industry also was just catering to that. And there were enough volumes happening. So no one was thinking beyond that. And for me, because I like doing new things anyway, and because I liked and was interested in options and trend following kind of ideas. So I said that, okay, that is what is larger globally. That is non-existent in India. So why don't we start doing some research on that and, making it more formalized in the country? So basically, I was among the first people to start doing research on the sell side on trend following, managed futures kind of ideas and options trading ideas, and then more dynamic hedging kind of things. And this virtually no other institutional guy was talking about in those years. This is 2004, 5, 6. Right. So I started the derivatives business at SSK in 2004. So the next 2-3 years, I was doing all this. So I was among the few guys who was doing all this research and then also marrying it with, like, let's say a large hedge fund or the prop desk of a bank. All the large banks had active prop desks in India. My largest clients were Morgan Stanley, Deutsche Bank, and then on the hedge fund side, Marshall Wace, a hedge fund from London. So all these guys would like my research around options and managed futures. And then if they would want to execute some large option strategies, then what I had done is, because of my interest in both the strategy side and people side of it, I used to be in touch with a lot of local prop desks, which were much lesser and much smaller in comparison to today. But there were still enough, who used to sometimes do the opposite leg of the trades. So, basically on the cash side, it's very easy to source blocks, etc., from other funds and other players. Option side, it is still not very common. But even in those years, I tied up that leg. So, based not everything, but a large percentage of the trades, if we wanted liquidity, then these guys would give us the liquidity. So then for the funds and for the global players, it was like, okay, here's somebody who understands the theory, who's giving us some new practical research also around these ideas and is also helping us source the blocks. So if we want to do large size, we can, right? Because otherwise, for some of the larger players, if you can't put on certain trades in size, then it just becomes like a theoretical exercise. Then what is the point in even talking about it? So if you can marry all of that, then it becomes attractive. And that's what luckily I managed to do at that time. So in fact, you'll be surprised to hear that I think in 2006, on one of the expiry days in one of the months in 2006, probably July, August or something, we did like $1 billion notional trade in index and Nifty options in one day, right? Which doesn't happen even today very easily on the institutional side. So that was, that is what used to give me the kick and the excitement around building all these various legs of the business.
And that was like very early into your career, and yet you got to, look at a leadership entrepreneurial role.
Yes.
And that must have given you a different outlook for the rest of your career.
Correct.
Like, how is that?
Yeah. No, so I mean, again, thanks to the founder and the CEO at SSKI to give me that opportunity. But yeah, that was something that was on my mind that, it could be interesting to be sort of semi-entrepreneurial at least. And that is what that opportunity gave me. And of course, that went well overall for the firm and for me as well. And therefore, I think since then, I've started out multiple times. So that is what, became exciting, that getting the independence, the freedom to deploy your ideas. And if you can do it in an intelligent and smart way and which impacts business and other people, then, it is much more satisfying as well. And since then, therefore, I have never so far felt the need to join very large organizations. They may become larger over time, like InCred is becoming now.
Like, would working in a Citadel or something, would that not be your piece of cake?
So see, never say never kind of thing. But in the past, when I've had some conversations with some of these guys, there is obviously the scale and magnitude can be very different. In the past, for family reasons, I've never moved abroad. So I've, for my working career, always been in Bombay, and I was born and brought up in Calcutta. Right. So I have had offers in the past to move to Hong Kong and Singapore and London, but I've never done that, more for family reasons, initially parents, their later wife, whatever. So that was largely the reason. But even otherwise, the good and the bad things, what I understood about some of those shops, I'll tell you. Obviously, the good thing is the size and scale can be big, if you're doing well. If I have the strategies for it, maybe they'll put on 200, 500 million, $1 billion also, which is not so easy to just raise in the local Indian markets and then deploy it, etc. Plus, a lot of the operations, compliance, all that will get taken care of because they would already have the teams. But having said that, you will still be, siloed in one kind of strategy, because there the goal is that you will have multiple PMs. A multi-manager shop is typically many PMs and many different strategies. And therefore, the strategy that you are focusing on, you focus on that, right? And then scale that up. So there, I feel I'm more of the kinds where, I would like to do many different strategies. Obviously, not things that I'm not good at.
Of course.
But over time, if you have 10, 15 interesting strategies, then you would like to deploy all of them and not be restricted on that front. And when you combine many different strategies, the advantage is that the non-correlation really helps. So, right? So you want to combine non-correlated strategies, and that way your risk reward improves even further.
Okay, that's very interesting. So, diving into the quant side of things, what's your quant outlook for the Indian markets? You could discuss existing quantitative strategies and potential new approaches.
Sure. Yeah. So, see, in India, last few years on the quant and even long short side, if I was to make it even broader, what has happened is that there is an acceptance now for what locally has come to be called absolute return strategies, which is basically a lot of long short and derivative oriented, low risk strategies, and obviously more market neutral or very low exposures, but make consistent returns, right? So there is a reasonable market among ultra HNIs and family offices on that side, where they don't want more than a 0.5% or a 1% drawdown, which is a decline or a loss. And over the year, if you're making 12, 13, 14%, then that becomes very interesting for them, because they say that obviously there's a taxation impact, because in an AIF fund, which is where you can do these strategies for the local investors, there is a full 39% taxation at the fund level, and it is not a tax pass through. So it is not as if depending on whether you are short term or long term, you will get the short term or long term capital gains tax. It is basically taxed at 39% every March at the fund level, and you get the returns as an investor post tax. Right. So that 39% is a very large number, right? So even if you make 13, 14% post fee, post tax, basically it'll come to the 7 to 8% range, right? So it's a big hit, therefore. But having said that, 7 to 8% for a liquid, almost fixed income like product is still very attractive, because no other fixed income options gives you that, right? Arbitrage funds are the best because of that capital gains tax treatment. But even they would, in the long run, fall in the 5 to 6% bucket. So you are basically 1 to 2% better than them also in the long run. And compared to FDs and liquid funds and short-term bond funds, which is where I think in India, most people have majority of the money, this is far, far superior. So, but obviously it is not as zero volatility or zero risk as those things, right? There is some minor volatility, but I think most of the managers in that space in India have done a reasonably good job, and therefore the larger, family offices have got comfortable with that approach. So there, what happens is there is a mix. There are some players who are doing fundamental long short strategies. There are a few like me who are doing more quant-based long short strategies. So there, what we do, for example, what I do is we have 3 buckets of strategies. One is more stock futures, market neutral. So there it is like based on different factor models. Like let's take a simple one like momentum, which I think everyone broadly knows about. And last few years, there have been many long-only funds also on the momentum side, both on the mutual fund and the PMS side. So what we would do is on that factor, we would rank the top 100 stocks, take the top 20 to long and the bottom 20 to short in an equal weighted manner. So it becomes like market neutral. So you have zero exposure to the markets, but you know that theme, even while being market neutral, makes 10, 12, 14% returns over the year. That's what the data shows. And therefore it becomes interesting, right? And then not one, but there will be 4, 5 different models like that, which we try and mix. So I have some momentum, some volatility, some sector rotation, some very short-term momentum models like that mixed on that side. But that is all stock futures-based market neutral strategies. Then we have a bucket which is relative value, where we'll do volatility arbitrage, volatility dispersion type of trades also. And then we'll do things what is loosely called special situations, in which, for example, merger arbitrage is something that I do very actively. And then the third bucket for me is index futures and options. So, which is again a mix for me. It is a mix between index futures and index options. But there are again many managers who would trade only index options or largely index options. And that is to do because India has become one of the most liquid index options markets in the world, second only to S&P. Right. So because of that, obviously there's a lot of liquidity, a lot of depth, even when you're scaling up. And it also means you can do many different types of strategies. So any strategy on the option side that you can think of, it is possible to implement it in India on the Nifty index especially, right? So that is why there are a lot of only option plays also. But like I said earlier, that because I like to combine many different non-correlated strategies, so therefore I have these kind of 3 buckets, and within each also many different types of sub-strategies. So these are the things that are happening already in India. What is more common though, as I said, is all these option-based strategies, whether discretionary or more systematic and quant guys. There is a whole host of people on the institutional side between funds and prop desks and even global firms who are active on the index option side. But index futures, like managed futures, trend following kind of things, which again, globally, there are a lot of large hedge funds in that space. And that is where, I also spent many years focusing on those kind of strategies between an India fund and an Asia fund also I was managing. Those kind of things are still very not common and very less in India as of now. So I think there is a big scope to do a lot of things on that side. And second, the market neutral, while I do it as one bucket, but again, that is not very common at all. So obviously for me, it is interesting because that means there'll be alpha there. But also it is very scalable. So while if you look at a few single stock futures and very short-term trades, it may not be. But the moment you start mixing weekly, fortnightly, monthly strategies, then and you combine the top 100 liquid stock futures in different ways, then there is a lot of scale that is possible there also. So I think on the managed futures trend following side and the market neutral side, there's a lot that can be done in India and can be scaled up as well, but is not so common. And index option side, pretty much all types of strategies people are doing.
And you've told us, how your bucket is split up in so many different strategies. Could you tell us what your overarching philosophy is when it comes to hedging these relatively large portfolios?
Low risk and hedged to begin with, but whatever is not, like let's say a long only. So the other fund I have is what is called DEAR fund, right? Dynamic Equity Asymmetric Returns. That is a long biased fund, right? Which means that there's a larger 80% allocation to long equities, long cash equities. And obviously, because I and my team are quant guys, so that long equities is also via a mix of many different factor quant models, right? But having said that, I'm a big believer in hedging out the tail risk. So even there, even though I want to be long equities on that bucket, I still buy out of the money put options as a tail risk hedge. Because the advantage is that in India, you have Nifty index weekly options, which are highly liquid. And the moment you start going 3, 4, 5% out of the money, they are very, very cheap. So therefore, there is no harm in buying some of those for some tail risk protection. And then I overlay some of the managed future strategies that I used to do earlier also on both the Nifty and the Bank Nifty index. So what that does is that it gives you a sort of a levered long on the upside, because when markets are in smooth upward momentum, then the Nifty and Bank Nifty index futures models go long one by one. And therefore, you're 80% long on the cash equity side. And let's say another 30, 40, 50, 60% long from the futures, you end up becoming 120, 140, 150% net long. But when markets are falling like the last few months, then your Nifty and Bank Nifty index futures models start going short and indirectly reduce the exposures of your long portfolio or indirectly be hedging it, however you want to look at it. So I like combining those two things, which is a tail risk, simple options hedge, with these index future strategies, which can become long biased or short biased, depending on the underlying trend and momentum of the markets. And that is a combination, to my mind and experience, whatever I've seen, is quite effective in the very long run. So that is what I say, that, even if you're long, why not have these kind of hedges? Obviously, if you have like a mixed mandate, which is long short, then anyway, you will have more market neutral and more option strategies, which will anyway hedge the rest of the book out.
That's very interesting, and there's a lot to break down there. All right. So, further going into your hedging strategies, machine learning has always been important in terms of creating these algorithms that trade. And you can hear the greats. Jim Simmons talks a lot about machine learning and mathematics. How do you use it within your practice?
So, see, on the AI machine learning side, if I could club it together, right now, so we have some people in the team who are, better at it than me and are more interested in it than me. And they've been doing their own research around strategies, etc. So it's a little early days for us on that side. But having said that, the sense I get is that more than actually getting specific strategies out of that process, the bigger use case there is to organize all your strategies. So for example, I may have done 1,000 backtests, let's say in the last 10 years, right? Now, but I'm using how many in my current two funds that I have, about 30 of the models. Some 15, 20 in one, 10 in another. So 25 to 30 of the models is what I'm using today.
Right.
Obviously, we have, depending on the product, a quarterly or semi-annual review and updates of the models and the combination of models that we want to use in the fund. But even then, it is more like that 1,000 has got condensed to 100. And then within that 100, largely that analysis is happening, right? But what about the other 900? And even when that 100 has become 30, what about the other 70? There will be days and weeks and certain market regimes where some of those will be more important than the ones that are running live. So that for normal, simple, systematic and quant processes to be able to manage that, obviously, humanly and manually it is impossible. But even other are normal, systematic and quant processes to handle that is not easy. But using machine learning, AI and all, you can actually organize that better where based on certain rules and certain metrics, some of them can keep coming, going, rather than, you having to do sort of a manual check every quarter or every 6 months. So I think there's a lot of value there that we see is possible to do.
And this is a very what if question, but that's everything about AI. What do you think its role will be in quantitative analysis, like 10 years down the line, 50 years down the line? Do you think humans are going to have to do this anymore?
Yeah. So I think I'm of the camp where I think the combination is more powerful, right? So this debate is already on, and I think there are extremes and then there are
industry,
and then people are saying combined. So I think combined because, for example, some of the simple code and some of the simple programs that we also write to be able to do the data crunching and backtesting and analysis of the output that comes. I think that, of course, over time, a lot of the simple stuff can easily be done by AI. Already, we are using a little bit of that for, AI for coding, and much more advanced versions will happen 5-10 years down the line. But again, that combination and interpretation, and then the practical side of, what can work or cannot work, and what is overfitting. So in the quant world, obviously, overfitting is the big problem. And somewhere when you're doing AI and machine learning and all, you are overfitting. But the difference is that in a normal industry, there are finite truths, right? And AI machine learning is finding them. In the markets, it is not like that. There are no finite truths. There might be infinite possibilities. And then there is no one way to look at the markets, right? So therefore, that overfitting tends to happen more when the moment you start using the same models for financial markets. And therefore, that dosage of practical common sense is required at different points in time. So that, I think, is almost impossible for AI to do even 10 years from now. So therefore, you will need people, and then the direction of research, etc., again has to be decided. So for all of that, you will need people. But for all the manual and grunt work, obviously AI will be very useful.
That's an interesting perspective. So, going back into your journey, I think your first role as managing director was in ProAlpha. How was that?
Yeah, so that was very interesting because basically I joined hands with this US hedge fund called Monsoon Capital. This was late 2007, early 2008, and my move from sell to buy side. And Monsoon Capital was one of the largest India-focused, structured as a hedge fund, entire money raised from the US, but was a long-only fund in the small-cap, mid-cap space. But one of the largest, monies raised entirely from the US, and the founder is an Indian, but born and brought up in the US completely. So like that way, an American. And he had a lot of friends in the US who are hedge fund managers and quant fund managers, etc. So while he was running a successful long-only fund in India, and that was the only business he was doing, he wanted to build that business by adding long, short and quant kind of flavors for India and Asia also potentially. So it was like a startup back in those days because we met and we liked each other, and he had money and he had prop money. He said, I'll fund you and your team, and we'll see how it goes next few years. And then I have a small FPI where there's friends, family money. So maybe first do my prop, test out your strategies on that, then start handling that FPI. And then after 2-3 years, if it looks like it's going somewhere, then we'll form a separate entity, which will then officially be the partnership between us. Right. So that's how it started. The India team of that fund that he already had a very large office. Half of it was empty. So I and a trader of mine just joined and started some strategies for him. And once that 2-3 year process went by and we realized we're good at certain things and it's heading in the right direction, as he said, then we formed ProAlpha, and which is why I was the MD and the CEO come CIO, because basically that entity was my partnership with Monsoon Capital. So it was from semi-entrepreneurial, it became fully entrepreneurial, or you could say a startup which suddenly started growing. And so that was very interesting, because earlier, although there were semi-entrepreneurial roles as we discussed, it was within a firm and you joined as an employee.
This was a full dive.
Here it was a full dive. And therefore, whatever, ups and downs that come with a startup, all of that was there. We had some great times and some very bad times. And, 2008 crisis, where his larger fund went through a big drawdown while I was trying to build my strategies. I could see the pain that he and his team went through. And that impacts you in different ways, right? Because initially we're $1.5 billion fund. Some small expenses here and there are very easy for you to do.
Yeah.
And that's the outlook he had. And then when you're going through that drawdown and that pain, then you want to be very tight on everything else.
Yeah.
So then you could see that attitude change in him and his core team. So all of that was good. Again, I was lucky to get that learning, while I just started out on the buy side. And then there were certain things because of that which struck. And the good thing was 2008, even global hedge fund managers who were around for 20 or 30 years said that this was a year they'd never seen.
Wow.
Right? It was a new year for them, that kind of a thing. And for me, it was the first year on the buy side.
Okay.
So learning, taking the learnings away from that kind of an year, which even 30-year experienced guys said was new for them, made me realize that, okay, all types of movements and all types of strategies in this year that I can test, will be very interesting for the longer run. So then there was a mad scramble sort of to test out everything live. Because again, in the quant and systematic world, everything looked good on paper. But the moment you start implementing it live, there are various issues that come up.
Yeah.
So you are like, okay, this is the best environment to test out everything that we can.
If it works here, it will always work.
Yeah.
Sort of. All right. And one thing that stood out to me is off your LinkedIn, that's where I took it, a close-knit, hard-working team to optimize returns. Now, I want to know what it's like managing quants under you. And, every quant probably has a slight tinge in their strategy in the sense that slightly different.
Right.
And you as a managing director have to account for everyone's, not opinions, but, you have to hear everyone out.
Yeah.
How do you do that while still, using your own philosophy at the end of the day?
Yeah. No, so 2-3 things there. One is that I've always encouraged, healthy debates and criticisms.
Yeah.
Between the core team and even to me, right? And obviously, in a team, although it's mostly been smaller teams, and that's been another thing which has, made quant interesting for me, because I always felt that traditional fund managers would need like hundreds of analysts to analyze all industries, all stocks. And here with 4 people, you can actually analyze everything that you want using the quant world. Quant tools and systematic tools and all. So that is what excited me. So therefore, the teams have typically been smaller only. But within those that team, obviously, there'll always be 1 or 2 people who will sort of be similar in outlook to you. Meaning, even if you break it down to as simple as, having a more optimistic outlook and a more pessimistic outlook on certain things. So my goal has always been to encourage the other side to therefore not feel shy or left out, but to actually more aggressively give their views, right? So I am a bit optimistic in life, and that comes across in whatever analysis I'll do. So the people who are similar to me, I mean, they are less important in that
regard.
In that regard and those discussions. But the other side, then I would, always ask them to play the devil's advocate and share their views more actively, and then take that into account, because that really helps in my opinion. And that way the team remains engaged, and they also know that, there's no politics or bias or whatever. And they're more free in sharing all their outputs and their thought processes. So that is one thing that has really helped me in ProAlpha, and even now at InCred, I have a very different team and very different combination as well.
Does it ever, go over the edge wherein the devil's advocate actually results in, diseconomies of skill, in the sense that you guys spend too much time discussing something which is not biased?
Yeah, so that is where then as a leader, you have to step in and say that, okay, this discussion is done, and, these are the takeaways, and sort of conclude.
Where do you find that barrier between I need to listen and I need to stop this?
So I would say 90% of the times, it has happened automatically, so I haven't needed to really step in. But yeah, 10% of the times you will have to do it. And it can be for a couple of reasons. One could be that the person involved, is just not listening to any logic that you're giving him.
Yeah.
There it's much easier. You just tell him that this is logical and you stop it, right? And in fact, even personally, I mean, I found that when you're deep into a discussion or some research and you get stuck, actually, when you take some time off, you get those eureka moments. You suddenly, something will strike you a day or two later, you're sleeping or you just got up and it will suddenly strike you, oh, this is what I was missing. So I think that taking a break, whether it's individually or for the team or for those kind of debates, is anyway very good. So then we do some things like that. Right. So that is one. And then to go back to your question also of how else to manage the team. So as you correctly said, different people have different ways of working style, different areas of interest too. So what I have tried to do since the last 15 years is try to have that balance in the team, right? So like in my current team also, there'll be people who are more interested in option strategies. So they'll be researching more option strategies. There'll be people who are more interested in factor strategies. They'll be researching those. So like that, every person, and then he's the leader, even if there are other people interested in that, but he's the senior most and he's the most interested in that area, then he's like the leader on those strategies. So then there are like sub leaders anyway within the team. So that keeps them motivated as well.
That's an interesting structure, because I would imagine it often, in my eyes, like as a third person outsider, it would often result in conflict. Is that generally not the case?
No, yeah,
okay, that's great. So
it helps to have everyone focused on numbers, finally, right?
Yeah.
So if everyone is numbers oriented, then they get it.
I think a part of it would be hiring also. You hire with the mind of how are they going to fit into the team.
Yes.
Right. Going back to your sector outlook your sector rotation model, which you touched upon earlier, I found that very interesting. How do you tell us about the model and which sectors you're looking at right now?
Yeah, so sector rotation model, I've been trying to develop that for many, many years. Luckily, 2-3 years back, finally, I zeroed down on something. So it's a mix of some quant techniques and some, for lack of a better term, I would call it loosely long-term sort of technical, systematic stuff. And the goal there is that, every few months or I would say every regime or sub-regimes also, there's a shift of which sectors are doing well. And even whether markets are in bull, even when markets are crashing, for example, in the past, in 2008 or 2020, you would see that some sectors are doing much better. Even mostly positive, but even if not positive, maybe flat or minorly down, then everything else is usually down. And even in bull markets, there are some which are leading. And I was trying to form thoughts and strategies around it, how to exploit that. And finally, a few years back, I zeroed down on this combination of quant and technicals, which could capture that changes in market, giving more flavor to certain sectors. And so we currently have like a monthly rebalancing process. And obviously, a lot of sectors don't change for a few months. But the monthly rebalancing is more like at a month end, you update the models and the analysis, so that in case sometimes, obviously, in fast-moving markets, there are faster changes that happen. So at least when that is starting to happen, then you can rebalance on a monthly basis. But otherwise, like I said, a few sectors which are very strong for 3, 6, 12 months, they'll keep coming for most of that period. And therefore, they would automatically become medium to long term in some sense. But at least the monthly analysis updates it. So whenever they are going out of flavor, they will get exited fast. So that is the thought process and the way we've designed it. Currently, again, we are sitting on month end today. So obviously the sectors which are showing up right now are again from a month to 2 months perspective. Interestingly, 3 out of our 4 sectors from last month are continuing. As I said, many would continue. So for the coming month, it is financial services, which is, some banking weightage is there, but it's largely the NBFCs and the other financial services companies. Which have actually been one of the strongest sectors in the last 6 months also. So even when markets have fallen, you will see that the financial services index, which is loosely called FinNifty locally, has not really fallen much. So it's shown that relative strength. and on all the other quant metrics, it's been coming up last few months actively. So that continues. That was there in Jan, Feb for us. It's continuing in March.
Okay.
Then we have metals. Metals again was a very strong performer in year or two back. Then last 6 months it had not been performing. It came into our models in February and has continued in March. And then we have infrastructure. That again was not there till January. Came after many months in February and has continued in March.
Okay.
And the new sector that is fourth, which is showing up for March, is the PSE, which is the Public Sector Enterprises Index. So again, very beaten down in the last 6 months of market decline because they were the best performers of last year. So they got beaten down more than other sectors. And I think some reversion to the mean signals are at least coming on that.
Interesting.
We try to have some balance on the four sectors that the fact that, we're looking at sectors which can continue their strength or momentum or at least relatively be better than other sectors means that some sort of relative strength and momentum and trend features do come in. And therefore, we try to have some balance that, one model is there which may have that strength in the longer term, but in the short term, it is sort of reverting, mean reverting, so that there is some balance between that momentum and mean reversion in the portfolio.
All right. And what do you think of the bear market that's been going on for the past 6 months now? You talked about fast-moving markets, bull markets. How does your strategy differentiate between bear markets, flat markets, bull markets? What is that for you?
No, so the whole idea of having a mix of many non-correlated strategies is that whatever be the type of markets, it can handle it.
Yeah.
Especially on the absolute return side or the low risk and fully hedged, protected kind of strategies. So, for example, the market neutral or the option strategies, it doesn't really matter whether markets are bullish, bearish, or sideways.
Sure.
On average, they should be delivering whatever their risk reward ratio or their alpha is, basically. For the long bias strategies, obviously it matters.
Yeah.
And that is where the hedge overlays and all that we spoke of earlier is what helps. But having said that, even on the long only strategies, we have a mix of different models.
Right.
So that is what balances it out a little bit. And that becomes longer term, more stable. So that is how we design the strategies. But coming back to your question on immediately how the markets are. So yes, on our quant models, we were getting the signals that October to March is going to be difficult.
Yeah.
In fact, in August, September, in some of the media interviews, I've said that also on record that, we expect September to March or October to March to be difficult for markets, and that played out largely. And now the signals we were getting was that from mid-March to April end, markets should have a bounce. So obviously the last week that has started post mid-March, but it's early days. I mean, there's more than a month left for end of April. I think 2nd April, all the talks between India and US on the tariffs and all are going to happen. So people, are looking forward to that. So there could be some volatility around it depending on the final announcements. But post that, I think, I would expect that till end April, markets should remain stable and more on the bouncy mode. But post that, I don't know, because what has happened interestingly is that in this decline of the last 6 months, certain medium-term negative signals have also got triggered. And when that happens, although the very long-term signals are still strong. So when that kind of mix happens, then the year typically becomes more like a tactical trading year rather than a secular or a bull market year, I would say.
Okay.
So I think you would get multiple opportunities to go long different sectors, go long different stocks, short different stocks also this year, and not just buy and hold in one sector or a few stocks. I think this is not that kind of a year.
Sure.
So I wouldn't say very bad year. I think large part of the damage is already done. But you would still see volatility up and down and would have to rotate sectors, rotate stocks to actually do well this year.
Right. So you already touched upon volatility, but when the market, I believe it's extremely volatile right now, how do you navigate it? Rotating sectors,
Yeah, so see, volatility, we break it down in different ways, firstly. So it's a very, very interesting and very large topic of its own in some sense, which, normal layperson doesn't really understand it that way. But I'll very quickly explain what I mean by that. So, when you say volatility, as a quant and more data guy, my question would be, do you mean intraday volatility, weekly volatility, monthly volatility, and even in that, let's say intraday volatility, do you mean market going down sharply and let's say the IVs of the option spiking. So what that means, therefore, for strategies is that there are very different strategies which will be better in these different volatilities. So again, you need to have a bouquet and a combination of strategies, which then collectively can handle all these volatilities together, right? So it gets very nuanced once you start going into that layer of depth.
Okay, yeah, it's out of the syllabus of this podcast. All right, that's great. So, you've talked about how 20 years ago, the hedge fund market in India was a percentage of what it is right now, a small percentage.
Right.
And it's grown a lot in the past 20 years, but it's still nowhere close to, say, America's or UK's hedge fund market.
Nowhere close.
Where do you see it going in the next 10, 20, 50 years?
Yeah. So I think on many things on the financial side, whether it was the launch of derivatives in India, whether it was the options market volumes going up, more usage of some of the strategies we discussed today. Everywhere, if you compare it to the US, we are like 20 to 25 years behind. Okay, in each of these developments, almost like clockwork. Each of these, when you pick 20, 25 years earlier, it's happened in the US, it's happening now here.
Fine.
So similarly, I think and now the inflection point is, according to me, coming. So obviously I started on the buy side in 2008, right? And I was waiting for this inflection point to come 5, 7 years earlier. So for me, it's a little late because I've been doing this for a long time.
Yeah.
But I think it's finally there because I've seen all these cycles multiple times in the last 15, 20 years. So why I'm saying it's an interesting inflection point now finally is because some of these strategies we spoke of today again have started taking off in terms of practitioners, more serious practitioners coming into the space, more education spreading, more of the end investors also trying to learn about it or getting interested in it.
Right.
All that has started happening in the last 3-4 years largely.
Right.
Before that, even that was not there. And then on the regulatory side and the larger fund side also, recently, for example, SEBI came out with these SIF regulations, which is SIF stands for Specialized Investment Fund, where basically in a mutual fund structure also you'll be allowed to do long short. So it is again a step forward, right? It will be very restrictive right now within the mutual fund regulations, but some simple long short strategies one will be allowed to do. And SEBI has shown that they are pretty receptive to opening up those rules if things are moving smoothly. So I think in the next 10, 20 years, a lot of these things will open up so that not only right now only AIFs are allowed or as an RIA you can advise some clients. So as long as more structures are there and more types of strategies can be offered by institutional players to the large family offices and corporate treasuries, then there'll be a big boom in these kind of things. So I think that all those baby steps have happened in the last 3-4 years, and now the regulatory things are also starting to happen. So therefore, I have no doubt that the next 10, 20 years, things will become as large as some of the things we've seen globally.
And, in terms of regulations and growing the industry and the community, you have your own LAQSA. Could you tell us about how it came about and what you guys are doing right now?
Sure. Yeah. So just for everyone's benefit, LAQSA stands for, the full name of the association is Lambda Quantitative Strategies Association.
Okay.
And I mean, the reason Lambda is out there is because this is a non-profit entity. It is in India what is called under Section 8, and it has those 80G tax benefits of a non-profit. And because because it is meant for the industry, so while I and my friend Pankaj, we started it, but we wanted to do this initiative for the local community, quant community in India, to get everyone together.
Yeah.
Just like globally, there are a lot of good quant associations and clubs in a lot of the advanced countries. And therefore, we thought, non-profit, at least that barrier in people's minds that, why are these guys doing it? What is the objective? Just goes away. So at least the initial resistance is not there. They know it is just for the industry. Right. So that's why we did it that way. And it came about because, I and Pankaj, we met many years back, and he's been more of a risk quant and been doing a lot of global research for a lot of global researchers and quant profs and all, and not too much linked to the Indian industry. And I have been completely the opposite, where I've been entrenched in the Indian industry, but done more things for India and more on the portfolio research quant side. And therefore, I know most of the people involved in the Indian side on the quant and systematic community. So we both realized that we have very complementary skill sets, complementary areas of interest within quant, and we have very complementary networks. And therefore, if we can put our hands together and heads together, then it would be a better impact for whatever we want to do in LAQSA, right? And then initially, when we were trying to get the right name and file for it with the authorities, we realized that the rules had changed a few years back. So if some of the old associations like IVCA and others, if you see, they do have the word India and Indian and for India, of India, by India kind of things.
Okay.
But now government doesn't allow that, because they say that if those words are there, somewhere they feel that to the public it can signify that it's sponsored by the government,
Yeah.
which it is not.
Yes.
And therefore they don't allow that. So ideally, I would have wanted to call it Quant Association for India or Indian Quant Association or something like that.
Yeah.
But we were not getting that. And then the typical words, alpha, beta, and all again, someone has registered it. So we needed some quant word out there, which was not taken, and therefore Lambda came about. So it was a lot of hit and trial more than anything else. And therefore that term, which is an interesting story. But yeah, on the association side, see, first the community has to be strong and all the relevant players in the industry have to be part of it for it to be considered important enough, and for everyone from practitioners to newcomers to regulators to government, everyone taking it seriously. So therefore, we started initially with a few events. We've done one small one in Bombay first, then a full day one in Bombay, and we've been super successful.
Yeah.
Both of them had were overcrowded. We had to call for extra chairs,
Wow.
kind of thing. And even though, like I said earlier, that I know most of the players on the institutional side, at least in the quant and systematic community. But even I was surprised because, there were many more who came who I did not know, or I did not know they were doing work on the quant side. So they were super successful, and we got a lot of feedback from the industry as to what they want to see going forward, etc. And we're doing the next one on 16 May in Bangalore also,
Okay.
which is again going to be full day, because Bangalore also, interestingly, now has a lot of institutional players on the quant side, both local and global. Bombay is by far the
Of course.
max, but initially when we were starting it, we thought that maybe Delhi or some other place could be interesting. But now our research shows that Bangalore is more interesting than NCR, for example. So these events are happening again to get everyone together, because people are either joining as members or participating in the events, or coming as audience or sponsoring or whatever, right? And now that we had the first few ones which are already been successful, and those I and Pankaj got our hands dirty and planned it fully ourselves. We also wanted to understand the process, because we are not event guys as such, right? But now, because they've gone well, we have a lot of people in the industry who are wanting to support it, volunteer, help us out. So I think going forward, these events and other planning around the association will become much more easier. And the website so far had been very static. Now we've just over the last month started updating it so that it becomes a bit active, and monthly things will be coming up there. Some global quant research and some excerpts of that, summaries of that will start coming up from next month. We've also, since February, started monthly webinars. So February, we had someone come and speak on some global stuff. This month, we had someone locally speak on some factor quant things. So every month, we'll have some different specialized guy on the quant or systematic side coming and speaking for 30 minutes to 1 hour with Q&A.
Okay.
And those will be open to everyone, whether you're part or not part of the association. More so that there is some interest and awareness that people get that there's this association which is doing some interesting work in India. And then as people get to know that and see some good sessions, then they'll become part of the association, right? And that is how the community will grow. And then, of course, learning sessions and presentations are also starting to happen. So, for example, we're also having some subgroups. Many people who are part of the association, some of them are saying that we want to mainly focus on factor quant investing. Some are saying we only want to focus on options investing. Some are saying we only want to do systematic technical kind of stuff. So like this, there are different subgroups. So what we are doing is that we are getting a team head for each of the subgroups, and then they would drive the agenda and keep doing the smaller meetups and catch-ups every few months. So that is also starting to happen now. And then, of course, like I said, Pankaj is been more of a trainer and a researcher. So he's very soon going to start a course for beginners on the quant side.
That's amazing.
So that will also start now. And then, we'll start with basics and then we'll go to more complex stuff also as we see more people getting interested and associated and wanting that demand, that demand coming in. So that is the second big agenda. And then I think first 2 years, it has to be these two things largely to first spread the awareness, spread the learning and the education and get the community together and build it strongly. And then once these two things have started happening well, then I think, policy and regulation and all of that also, one can be a bit more active in giving feedback to exchanges and regulators and government. Because, so that is also a large goal over time, but I think you can break it down into short term and more longer term in this.
Talking about regulations, another interesting question that came into my mind. If you were to change a single thing in the regulationary space of the quant industry in India, what would it be?
So see, immediately what comes to mind is what I'm doing day in, day out right now for my bread and butter day job, right?
Yeah.
So I'm running these AIF funds, alternative investment funds, and in India it comes under category 3. And category 3 AIFs, the rules are that your gross exposures cannot be more than 200%. And what that means for a hedge fund or a long short strategy is if I go 100 rupees long and 100 rupees short, then my gross exposures are 200.
Fine.
So I can't do anything else.
Do that.
Right? Whereas my margin being used maybe only 30 or 40 rupees out of the 100 that I have.
Interesting.
Right? So I can't deploy my full money. And if I have low risk strategies, it's not even that, my 0.5% drawdown will become 10%. Maybe my 0.5% drawdown will become 2%. But instead of 12, 13, 14, I can give you 20, 21% return. So for investors, that would be brilliant, right? If I can give them a much higher return with very marginal increase in risk, which they don't care about because it's not a lasting loss. It is just like on a rolling 2-3 month basis, right? So I think it will be very healthy for the industry, very healthy for investors also, if those limits are there. And these AIF regulations came in 2012. And of course, the regulators had said that, it is very new for India, very new for them also. And over time, if things are stable and there are no big mess ups that happen from the managers who get active in these category, then they are open to opening up these exposure restrictions over time. But now we're sitting in 2025. So it's been 13 years and the rules haven't changed at all on that front. So I think it's high time that, those gross exposure restrictions get taken off. One idea there, in fact, which I and some of the associations I've been part of have, there have been some councils and like IVC also has a Cat 3 council. I'm part of that for this year. So from there and from some of the earlier forums I've been part of, also we've represented to the regulators. And one simple idea we had given them, which I think is quite interesting and easy to sort of implement, is that to begin with, maybe the exposures can be thought of on differently for not net exposures and gross exposures.
Okay.
So net exposures 200% is fine because it's a very aggressive number. If I'm 200% long the markets or 200% short the market, it's fine. It's not a less number, a small number. But gross exposure side, if I'm running low risk and fully market neutral strategies, then at least 400 or 500% as a first step is a good number. So I think if we break it down into net gross and have two different numbers for that, I think that will be a good start. So I think that is one good step in that direction. But further, it can get clarified if the net and gross get broken down.
Right. And again, a further extension on the regulations part. Do you ever see that in India, it's sad to say, but in America, hedge funds have sort of a bad rep? After all the implosions that have taken place in the last 10, 15 years, you hear like the Bill Huang implosions. He had 2 hedge funds implode under him. Do you ever see that happening in India wherein overambitious managers?
No, so I think regulators are doing a great job here because all these restrictions, while from a practical side, I'm giving some ideas, which are again, like from a global scheme of things, I think these are very small changes. These are not like, in the US or globally, the hedge funds that you mentioned and some others, they would have taken 10x, 20x, 50x leverage also. So LTCM, for example, right? You're running stat arb strategies, but you're taking a 50x leverage. So even if a 2% move happens, you will get blown out, right?
Yeah.
So that is where some common sense has to come in.
Yeah.
And here you cannot even do that because the regulatory things are very, very tight.
Yeah.
And I don't think we'll ever reach the stage where, the regulator will say you do 50x leverage. So I think that itself will stop it. Having said that, I mean, 1 in 1,000,000 cases, someone on an advisory side or on a personal level may be doing things which we will never even know of, where these things could happen. But as an industry and more from an institutional side, which I am part of, and LAQSA is focused more on institutional quant people, I think from both InCred and LAQSA standpoint, I don't think that's very easy in India because of the regulatory oversight, which is good.
Yep. I mean, I don't know if you've heard of WallStreetBets.
Yes.
Sometimes you look at, Bill Huang, who lost $20 billion in a matter of, I believe, a couple of years. It's like they're like these individual retail investors making decisions at an institutional level, and they lose so much money. It's sort of amusing to look at as a third person. Do you think India's regulations are just too bulletproof for that to happen at a large scale?
Yeah. Right now, yes.
That's good to know. All the investors looking at, yeah, interesting. So, wrapping up everything together, let's take an example of my friend Tejas. I hope he's watching this. He's studying for JE right now, but he really loves, hedge funds, quantitative analysis. He wants to get into it. How would you advise someone our age to first look at a future in the industry? Of course, we can't get into it right now. Look at a future in the industry. And how would you, second, advise a professional who is slightly older than us who wants to excel in the industry?
Got it. No, that's a great question. So, see, for you and your friend and, people of your age group, if you're interested, then obviously I think I like, podcasts and interviews like this because there are so many other such interviews of some of the biggest names in the space out there. And even when I was very young, I used to listen to some of these because you can learn from other people's experiences, right?
Exactly.
Instead of going through the grind and ups and downs yourself, if you can avoid some of those mistakes because they're telling you, thinking like this will be a mistake, then that learning curve can be very fast.
I mean, I'm sorry to cut you off there, but I was listening to a podcast today, and it was by Chris Williamson, and he essentially said that people, despite being able to learn from other people's mistakes, generally want to learn from their own mistakes at a better level. And I think that's amusing because you can save money, time, stress, depression, amongst other things. But, learning from professionals like you firsthand is amazing.
So I think that is the best according to me, and that has helped me in the past a lot. But you're right. I mean, it's not easy to do. Because human psychology is like that, right? I mean,
I'm going to be different.
I'd better be different. Ego comes in, I can do better than this. I can take that idea, but I can do it differently and better, so all that comes in. But I think first few formative years, it's good to just absorb everything. And then your style will form. Like I said, when I started out, there were 50 things I wanted to do live. And luckily, I got someone who seeded me, who said that, okay, go and try those 50 things out, as long as you're not blowing my money, within some risk constraints. And then let the live experience tell you, what you want to do. So if one gets an opportunity like that, great. But otherwise, you have enough platforms online nowadays which allow paper trading kind of things. So it's almost like giving you the real feel. And therefore, you can test out a lot of ideas before actually putting your money to play. So one is, I mean, here, hedge fund managers, read about them. So books. So I've learned a lot from reading books. I mean, my
favorite books.
I have like a library of books. So I think Fooled by Randomness by Taleb is a great book. I mean, it's not fully quant and strategies per se, but just about, the thinking process and the typical issues, how humans think and how they do or see or do not see probabilities, etc. And then some of the behavioral economic stuff of Kahneman, Tversky, and all these guys. So some of their books, Thinking Fast and Slow, it's right there in my cabin. And some other...
It's one of the greatest books on psychology.
And there are a few more, I'm forgetting their names now. But books, there are, more systematic, technical, more quant kind of books. There are books which teach you how to think about position sizing and risk management, which is less talked about, but actually in my live experience more important than just the strategies. You and I may have the same strategy, but the way I'll position size it and risk size it will be very different, and we'll end up getting very different outcomes. So I think that there's a lot to actually learn and implement there, more than what anyone does.
Yeah.
So those sorts of things I think can really help. And obviously compared to 20 years back now, you have a lot more material out there simply online.
Your course is coming out.
So yeah, so all that is there to help.
Yeah.
And then the other thing you asked is about people who are already in the industry. Again, some of the same things can help because, strategies that they want to understand or learn, there's so much material out there. Someone wants to go more deeper into quant, then CQF is a great course for the quant guys. And then there are other financial engineering courses here and there globally, which are very interesting for the background for all this as well. And then some practitioner courses are there both locally and globally, which also help if one wants to keep upgrading their skills while being a practitioner in the space. And again, on that side, LAQSA will keep doing stuff as well going forward.
That's amazing. I think viewers got a lot of value from especially this last segment
Great.
you told us about. It's amazing good to have you on the show.
Same here.
Where can people keep up with your work? What you're doing, LinkedIn?
Yeah. So some good thoughts, good ideas, new things I keep posting on LinkedIn. Yeah.
All right, we'll link those. Thank you for coming on the show once again.
Thanks for having me. Great.